If you are a business owner, you know that access to capital isn't just a goal. It is like the oxygen your company needs to survive and grow, but getting access and getting it on your terms, big amounts, low rates, that all comes down to one fundamental thing that honestly, most small businesses overlook: business credit.
Exactly. When you're growing, your business needs to signal reliability, trustworthiness, and it needs to do it immediately. Business credit is that signal. It's what tells the world that you are financially stable, responsible enough to handle growth. If you don't have it, you are constantly relying on your personal finances, which,
Yeah.
well, it means you are limiting your potential right from day one.
Okay, so that's our mission for this deep dive.
Yeah.
We are taking the essential sources and distilling a clear, structured roadmap on how to build strong business credit, right from absolute scratch. We're covering the mechanics, the 3 key bureaus, and the 9 most actionable steps you can take today to build a separate financial identity for your company.
Yeah.
Before we hit the road, let's check the engine, so to speak. What exactly are we building here? What is business credit, and why is this separate financial identity so crucial for you, the small business owner?
Sure. So business credit is simply the measure of your company's ability to manage debt. It's all captured in business credit reports. These reports basically aggregate every interaction your company has had with vendors, banks, lenders, establishing a track record. It's a completely independent financial persona for your business entity.
And what does establishing that persona unlock? I mean, beyond just getting a loan.
Right. The benefits start with access, of course. You're more likely to get approved for financing. But the real strategy is in the leverage it provides. Better credit means better terms. We're talking larger loan amounts, dramatically lower interest rates, longer repayment schedules. Basically, the cost of capital plummets when your credit profile shines.
Yeah, and I found the information on vendors in our sources really interesting.
Oh, yeah, that's where the power of reputation really kicks in. Suppliers will offer you net payment terms, net 30, net 60, net 90. Strategically, this is huge. You get the inventory or services today, and you don't pay for weeks or even months. It's effectively a zero-interest, unsecured line of credit, just granted purely on your company's good name. That float lets you manage cash flow incredibly well.
And there was that great detail about operational costs too, right? Insurance.
Yes. Surprisingly, good credit scores can actually lead to lower business insurance premiums. Insurers tend to view financially stable businesses as lower risk overall. It makes sense. But the most critical benefit, the one that should, motivate every entrepreneur, is liability separation.
Let's talk about that separation, maybe use an analogy.
Yeah.
Because it really is the cornerstone here.
Okay, yeah. Think of your business like a young adult opening their own first bank account, getting their own first credit card. As long as you, the owner, don't personally guarantee the debt, don't co-sign, then whatever the business does financially stays strictly on the business's record. It limits your personal exposure. If the business, say, defaults on a loan that was purely in its name tied to the EIN, the employer ID number, that default hits the company's credit, not yours. Yours is tied to your social security number, your SSN. It's separate things.
Okay, that separation is exactly what we are after. So before we get to the roadmap, how does this whole system actually work? Who are the judges of business reputation?
It works pretty similarly to the personal side, really. But the business world relies on 3 key players. Dun & Bradstreet, usually called D&B Experian, and Equifax. Each one tracks the activity of the business entity, compiles reports, and issues its own proprietary scores based on all that data.
So when a third party, maybe a lender, pulls a report, what specific details are they looking at? It sounds like it's more complex than just a FICO score.
Oh, it's far more detailed, yeah. They look at basic company profiles, name, address, how long you've been in business, maybe employee size. But the core is the payment history that's tracked via trade lines. These are just reports from your vendors or lenders detailing if you paid on time, late, or maybe even early. They also track the negative stuff, obviously collections, bankruptcies, lands, judgments, all that goes in the file.
Right. And I know each bureau has its own way of grading risk. Can you give us an example of one of these proprietary scores?
Sure. D&B, for instance, uses its delinquency score. It's on a scale of 1 to 100. And it's specifically designed to predict the likelihood that your company will be severely delinquent, really late on its payments in the near future. Lenders use that score, not just your overall profile, to kind of gauge the risk when they're deciding on approval and, importantly, the terms.
Okay. This brings us back to that crucial distinction. Business credit tied to the EIN, personal credit to the SSN. But tell me, when can these two worlds collide? Because sometimes they do.
They absolutely can. They collide when the lender requires a personal guarantee. This happens a lot when you're starting out or maybe seeking significant funding. The business just might not qualify on its own yet. So if you personally guarantee that debt, you're basically linking the two systems. You're putting your personal credit on the line. If the business fails to pay, the lender has the right to come after you personally. And that default will absolutely tank your personal credit score. That's why the long-term goal is always to build enough strong corporate credit to eventually borrow without that personal guarantee.
Right. Strategic separation. That leads us directly into our 9-step roadmap.
Yeah.
For anyone listening, these first 4 steps are like totally non-negotiable prerequisites. We call this phase 1, establishing formal identity.
Okay, step 1, get formalized. While you can operate as a sole proprietor, to truly build separate business credit, you really need a formal legal structure. Think LLC or a corporation. And you must register it with your state. This is what actually creates the legal entity that can acquire its own credit.
Okay. Step 2 is foundational. Open a dedicated business bank account immediately.
Yes, this is more than just, good bookkeeping. It's pretty much mandatory for most credit applications. Lenders need to see a clean separation of finances, they need to verify your revenue flow, and they need a place to deposit funds that exactly matches the legal name on your business application. Mixing personal and business funds it's the fastest way to muddy your financial waters and raise red flags.
Step 3, and this is where I hear many small businesses kind of trip up, is dedicated and consistent contact information.
Consistency is everything here, really. Get a dedicated business phone line, a physical address, not just a P.O. box if you can help it, and a domain-based email address, like you@yourcompany.com. The key is using that exact same information everywhere. On your bank forms, state licenses, IRS filings, every credit application. Seriously, we've seen businesses denied credit just because they listed their home address on one form and a P.O. box on another. That inconsistency signals instability or worse, maybe potential fraud to lenders and bureaus.
Wow, that's such a powerful point. That tiny inconsistency can stop the whole process dead in its tracks.
It absolutely can. And step 4, the literal keystone. Get your 9-digit EIN from the IRS, your employer identification number. It's free, it takes minutes online usually, and without it, you can't open that business bank account, you can't apply for most credit, and you have no independent tax ID for reporting. It's basically the business's social security number. You gotta have it.
Okay, so once that foundation is solidly set, we move to phase 2. Generating a file, we need to actually start getting things reported about the business. Step 5 is often misunderstood, I think, the DUNS number. Why is this specific identifier from Dun & Bradstreet so critical?
Right. This is a key tactical difference between the bureaus, Experian and Equifax. They usually wait until they receive trade line information from a third party, like a vendor reporting you paid them, before they even create a file for your business. DNB is the exception. They let you proactively establish yourself in their database. You do this by applying for this DUNS number. It's a necessary step just to get on their radar and initiate your first report. And you can usually get it for free within about 30 days, which is much faster than just waiting passively for some vendor to maybe report you.
Okay, that's the strategic nugget right there. DNB is your proactive starting point. Makes sense. Now, steps 6 and 7 are about getting your first trade lines reporting. What's the difference between starting with a secured card versus vendor accounts?
Okay, so a secured business credit card, that's step 6, and a great option if you have absolutely zero history, especially if you think you might need bank financing sooner rather than later. You put down a deposit, that's the collateral, which guarantees your credit limit. But the crucial part is the card issuer reports your good management paying on time to the bureaus. The goal, obviously, is to prove responsibility and eventually graduate to a regular unsecured card.
Okay. And step 7, the vendor trade lines, that kind of leverages your existing relationships, right?
Exactly. This is often the easiest entry point for many businesses. Identify suppliers or vendors you already use. Think office supply companies, shipping providers, maybe industry-specific wholesalers. Look for ones who offer net 30 terms, and this is critical, who report those accounts to the business credit bureaus. Not all do. Getting goods now and paying exactly on time, or even a bit early, builds positive payment history very quickly.
Got it. Finally, step 8, round out the profile with potentially a business loan.
Yeah, this is often more for diversification later on, but if you do take out, say, a small startup loan or maybe equipment financing early, the absolute main mandate here is ensuring the lender reports that activity. Ask them up front. Many smaller regional lenders or even some alternative online sources might not report to all three major bureaus, or maybe not at all. If your payment activity isn't being recorded, you're basically paying interest for zero credit building benefit. So always ask, which bureaus do you report to and how often?
Okay, so we've built the initial profile. Now we enter the phase of discipline. Step 9 is maintenance, and this is really where the long-term strength is forged.
Right.
What are the two critical non-negotiables for sort of uh, daily or monthly
And
maintenance?
one for one, payment history. Nothing, absolutely nothing matters more. Timeliness is gospel, you must pay on time, or ideally, pay early. A single 30-day late payment can dramatically offset months, even years of perfect behavior. Set up automated payments for everything you possibly can. Just take the risk of forgetting out of the equation.
Solid advice. And number 2 is managing utilization, specifically on revolving credit-like card. How much should you actually be using?
Yeah, this is key too. You should aim to keep the balance you carry below 30% of your available credit limit at all times. So if you have a $10,000 credit line, you should ideally keep your outstanding balance under $3,000 when the statement closes. Low utilization signals to lenders that you're in control of your debt, that you're not reliant on every single penny of available credit just to operate.
Makes sense. As the business matures, the focus shifts a bit to strategic diversification. Why do lenders care if I have a mix of different credit types?
Well, lenders want to see that you can handle different kinds of financial products responsibly. So, a mix of revolving credit, like credit cards, installment debt, like term loans where you pay fixed amounts, and trade credit, those vendor accounts we talked about. This diversification helps you score well across what they call the 5 C's of credit, which are sort of the core metrics lenders use to assess your application.
Let's quickly simplify those 5 C's for the listener. What are they looking at?
Sure, think of them as 5 lenses. Character, that's basically your payment history, your track record, your reliability. Capacity is your ability to actually repay the debt, usually measured by your cash flow and debt ratios. Capital is the money you personally have invested in the business. Skin in the game. Collateral is any asset you pledge to secure a loan, like equipment or real estate. And conditions refer to the purpose of the loan itself and also the general economic environment at the time. By maintaining diverse, healthy accounts, you're demonstrating strength, especially in character and capacity.
Okay. Now, here's a significant point of maybe Payne mentioned in our sources, monitoring your business credit. Unlike personal credit, businesses generally aren't entitled to free annual reports. Why is paying for monitoring almost mandatory?
Because you simply cannot manage what you cannot see. And errors on business credit reports can be, frankly, much harder and slower to fix than personal ones. It can take months sometimes. If you don't monitor regularly, you could apply for a vital loan only to be blindsided by a major error, or maybe a missed payment reported by a vendor you didn't even realize was reporting. It happens.
And these monitoring costs, they vary quite a bit, don't they?
They really do. Experian, for example, offers single reports for maybe under $50, but ongoing subscriptions can run close to $200 a year. D&B has various tiers. Some have limited free info, but the really actionable data tiers can cost upwards of $149 a month. You just have to factor this expense into your budget because being surprised by a poor score during a critical lending application is way, way more costly than paying for the monitoring service proactively.
Right, it's an investment, not just an expense. So if we're committing to this whole process, what's a realistic timeline for seeing real results?
Definitely need to be patient. This is a marathon, not a sprint. Expect maybe 6 months to a year just to see meaningful growth, and for those initial trade lines to properly show up across all three bureaus. Establishing a truly strong profile, the kind that commands the absolute best rates and terms, that's likely going to take a few years of consistent, disciplined financial behavior.
Okay, this roadmap provides, I think, immense clarity on a topic that often feels pretty overwhelming. We've established that the foundation is that non-negotiable legal and financial separation. And the execution really relies on disciplined, timely payments.
Absolutely. If you internalize just one thing today, make it this. Consistency in payments drive your character score, and low utilization drives your capacity. Those two factors, consistently managed, will move the needle more than almost anything else.
Great summary. We'll leave you with this final really crucial thought from one of the experts in our sources. Credit is never an issue until it becomes one. So being proactive as a business to understand where you are at all times is of the utmost importance. Don't wait for the crisis.
Yeah. So our immediate challenge to you listening is twofold. First, go check off those foundational steps we talked about. Legal entity, dedicated bank account, EIN, and consistent contact info. Lock those down today if you haven't. Second, start actively investigating your first trade line, whether it's going to be a secured card or finding a reporting vendor account. Identify who you'll open it with. Commit to making that first payment early. Start building that history now.